Good morning, everyone, and welcome to Managing Cash Flow. I'm glad you're here. Make sure that you have your participant manual. Download the participant manual for managing cash flow and use that as a follow along tool. So, again, welcome everyone. Thank you for being here. It's probably going to be something that you already know and that you're already doing. And then we're going to show how you can do that in your business. So here's the information about the participant guide. This is where you're going to get your participant guide. So what are we going to do today? We're going to talk about Bob and the wired cup as a case study. What I really want you to think about from the case study standpoint is not only what would you do for his business, but what would you do for your business? So we're going to look at things that I know you're just so interested in, like balance sheets and profit and loss statements and all those reports that you look at and go, I have no idea what this is or what I'm supposed to do with it. So by the time we finish this, I hope you don't ever say that again. You do know what it is, you do know how to read it, and you do know how to use it to help you make better decisions. This is definitely dedicated to you as a small business owner. We're going to look at how money comes into your business and how money goes out of your business. We're also going to look at the cycle of money, how money moves, and how do you use this information to make the best decisions about you and your business. So when we actually look at how money moves, and like I said, this is probably not going to be that alien to you because you've been doing this for a long time. You've been watching money come into you and go out. You have already been making decisions about how money comes into you. Is it a salary? Is it a gift? How did you get the money? And then you make decisions about where the money goes to. Am I paying household bills with it? Am I buying a gift with it? Am I going to the movies with it? So you're already making all these decisions already. And in the process of making those decisions, now when you go to doing that within your business, it's the same concept. So here's Bob and the wired cup. So Bob recently opened a new bakery cafe, the Wired Cup. The cafe has a great location in a small college town. And to get started, Bob invested $30,000 of his own money and received $20,000 loan from a commercial bank. He spent $45,000 on startup costs, leaving $5,000 to run the business. So the Wired Cup is already popular with students, university staff, and neighbors. Everybody loves the coffee and the baked goods. A college dean has started to order croissants for the faculty dining hall. Bob is building a great new business. However, Bob has concerns. He's not yet paid himself, and he wonders when he can. The $5,000 is almost gone, and given that his key customers are students, he assumes many will go home over holiday breaks and the summer. So questions that Bob is now asking are, how will he pay his bills if there are fewer customers? Will he have enough money to ramp up again in September? Should he buy in bulk to reduce his costs? And will suppliers allow Bob to buy on credit, or does he still have to pay cash? The good news is Bob is thinking ahead. He has time to find some solutions, and as we review the Wired Cup, we want to look at the cash flow issues, and you'll be able to apply these concepts to your own business. So Bob is just going to be our example, but I want to make sure that as Bob is the example. You are actually looking at this in terms of how this affects you and affects your business. So, as a business owner, do you think you are a beginner, an intermediate, or an expert? And what does that mean? So it says, so where are you on the cash flow continuum? Do you understand how money comes into you, into your business? And do you understand how money goes out of your business? Or do you have kind of an understanding, but you still have some questions? That's the intermediate piece. If you have a good handle on how your money is moving in and out of your business, then you have probably still some questions, because now if you have a good idea of money movement, you may be looking at money movement in your household versus money movement in your business. So we want to touch on all of that so that you can see the concept of money movement is the same no matter where it is, no matter where it's coming in from or whether it's going out to, it is still the same concept of money management. It's the same concept of money movement. So this is a balance sheet. I know I can't see you, but I know you're all just smiling because we're going to talk about a balance sheet. Aren't you thrilled? What is a balance sheet? A balance sheet has three different areas that we want to pay especially close attention to. So the balance sheet has something on it called assets. It has something called liabilities, and it has something called equity. So let's talk about what those words mean and what that impact has on understanding how our money is moving. Assets are the things that the business owns. So I own my cash that's in the bank. I may own some inventory if I'm selling products. So I'm looking at things that I own that allow me to say these things belong to me and my business. So I don't have to worry about them. I already have a handle on them. I know what they are and they're mine. But then I'm going to look on the other side and I have liabilities. Well, what are liabilities? They're just the opposite of assets. Assets are things that I own, but liabilities are things that I owe. So, quick example. I went out and bought a car for the company. And let's say my car costs $25,000. When my accountant or my bookkeeper puts this transaction into my books, into my transactions and into my accounting books, my bookkeeper is going to say, well, the car that I purchased as the owner, is an asset. And I paid $25,000 for it, so my assets increased by $25,000. I now own something that is $25,000. But how did I pay for it? That's the big question. Did I take $25,000 out of my company checking account and pay for the car outright? Or did I put a down payment on the car? Let's say I put down $5,000 on the car, and then I went and got OPM, other people's money. I got an auto loan for the other $20,000. So that means that my asset is still $25,000. But how am I paying for it? I'm paying for it with a liability. So now that means that I have a payment that has to go out to make that loan become less and less and less as I pay it down for the car that I purchased. So there's several ways of looking at this, and I want you to think in terms of assets are looked upon from an accounting standpoint. Assets are looked upon as what did you pay for the car? Doesn't ask the question about how you paid for the car. It asks what did you pay for the car? That is always going to stay the same. If I paid $25,000 for the car, the asset is always going to be $25,000 because that's the amount I paid. That doesn't change. What does change is my liability. I went out and got a loan for $20,000 to help me pay for my car. And each time I make a payment on that liability, the liability becomes less and less and less. And eventually, that liability is going to go away completely because I have now paid it off totally. Now, from an accounting standpoint, that $25,000 is what I paid for the car. The $20,000 is the loan that I took out to pay for the car, and that loan gets less and less and less. So what is this thing down here called equity? So I know assets are what I own, liabilities are what I owe. What is equity? Equity is what is my business worth. So in accounting, we do mathematical equations. And the mathematical equation for balance sheet is assets equal liabilities plus equity. So if I've got $100,000 in assets and I've got $50,000 in liabilities, then I have $50,000 in equity. They must balance. That's why it's called a balance sheet. Assets always have to equal liabilities plus equity. Or just like in algebra that we learned, that we can kind of move that stuff around. We can say assets minus liabilities will equal my equity. My equity is basically what is my business worth? Did I put money into my business to get it started? That's part of my business worth. Did I make a contribution to my business? Did I have some savings that I had set up? And of that savings, I put that into my business. Let's say I put $10,000 into my business. So my equity would be $10,000 because that's the worth of what my business has. When I look at my assets, what I own, I look at my liabilities, what I owe, I'm always looking at where's my worth? What's the worth of my business? If I want to put more into my business, if I feel that there's something that I need to do to build my business up, I can put more money in, I can contribute more money to the business, I can add more to it, which would increase the equity of my business. And when I do that, my balance sheet says that now I've got more money in the business, which means that money, that $10,000 that I put in, that became $10,000 that went into my bank account on one side, and it is the $10,000 that is part of my equity on the other side. So again, the balance sheet has to balance assets equal liabilities plus equity. Don't get confused over this. Just remember that my balance sheet tells me where my business is as of a particular day. So if I come to your business as an accountant and I'm looking at your books, all your transactions for how your money has been moving in your business, then I'm going to say, well, I'd like to see your balance sheet as of last year. That means that we're going to go into your software. We're going to look for a balance sheet and we're going to put in a date as of December 31st, 2025, because that would be last year. And it will tell me, it's a snapshot. It tells me a picture of your business as of that date. It tells me what you have in assets. It tells me what you have in liabilities, and it tells me what you have in equity. If I say I would like to see your balance sheet as of last month, then I'm going to put in last month, which is the last day of last month. Okay, so this is now May, so it would be April 30th, 2026. That balance sheet is going to take a snapshot of your business as of that day. If I say I would like to see your balance sheet as of right now, we're going to put in today's date. So you see that the balance sheet is like a snapshot of where your business is, where your money is, what is going on with your assets, your liabilities, and your equity as of a particular time. Why are we even interested in a balance sheet? What are we looking for when we look at a balance sheet? One of the things that we're looking for is, where do we stand? What's going on in my business? I really need to know how my money is moving in my business. I need to know how much I have put into the business. I need to know how I'm using that money in the business. And I need to know, do I need to add something to that? Or am I moving in the right direction? So when we look at let me go back to the balance sheet. And this is Bob's balance sheet for the Wired Cup. So the opening balance sheet tells the story of how much money Bob used to start the business. That was that $30,000 that he said he got. Okay. And so he put in the $30,000 of his own money. That's owner's equity. So right now, the worth of his business is $30,000 because that's the money that he put in. He borrowed $20,000 and he's got to pay that $20,000 off over 5 years. So as Bob pays that, now that's a liability because now that's something that he has to pay. So that's not something that he owns, that's something that he owes. So as he pays down on that, we'll notice that the liability becomes less and less. So if you don't have necessary capital to start your business, you have a couple of options. You can put in money for that you've saved up. You can ask family and friends. You can get a business partner. Okay, so there are options that you can have that will give you that seed money or that working capital to have the business get started. If you don't have that as an option, if you don't have a business partner, or you don't have somebody who can loan you the money, or you don't have the money that you've already saved up, then you go into debt. And debt is when you use OPM, which is other people's money. And that's okay to ask other people for their money. But what you have to do when you ask them for their money is that you have to play by their rules. And always be clear in that conversation when you're asking for a loan or you're asking for somebody else's money. Know what the guidelines are. Don't guess. Don't think you have this. Oh, my friend George in New Jersey told me he's got the same kind of loan, and this is what they do for him. You're not George. You're not in New Jersey. You are you. This is your business. You ask questions. There is no question that cannot be asked. You need to be very clear what you're getting, how you pay for what you're getting, because what does a funder do? What does a funder sell? Funder sells money. And how does the funder get paid? They get paid by you paying back that money, plus you pay a fee. That's an interest. So when you look at, you said, oh, I got this money over, I got $20,000 and I'm going to pay this over 5 years. That's pretty easy. I'll just kind of divide it out and I know how much each payment is going to be. The answer is no, you don't. Because what the funder is going to tell you is what the payment will be. And the funder is going to tell you so much of this is principal and so much of this is interest. The funder will tell you what the interest rate is. There's a big difference between having a 12% interest rate and a 3% interest rate. So the funder is going to give you all of that information. Now let's think about that when we're talking about using somebody else's money, whether it's to buy a car or whether it's to put into the business so we can get it started. We want to be the kind of business that a funder looks at and says, I want to do business with this company. I want to do business with this person. I think this is a good, and this is a four-letter word that you need to have a good handle on, risk. I think this is a good risk. So let's just switch this around for a minute. Let's say I'm the person who needs money and you're the funder. You've never met me before. We don't have a relationship. And I come in and I talk to you and ask you, can I borrow $20,000 to get my business started? Are you just going to say, oh, sure, no problem. You look like a nice person. I'll just give you the money. Of course not. What they're going to do is ask me for information that makes them feel comfortable that I am a good risk. So if I'm asking you for money, you're asking me questions. And if I don't like the questions that you ask, I need to go find another lender because you have what I want. I have to play by your rules. So you want to know what my credit score is? Ugh. My credit score is not all that great. Be honest about your credit score and why it is where it is. Be honest about what you're doing to bring that credit score up. Also, have a conversation with the lender to see if there are options in how much you can get and what kinds of programs that they have, whether it's a bank or a credit union or an individual funder, or doesn't matter who you're talking to, you are talking to somebody that you want their money. So you're going to be asking them questions about what they need from you, and you need to answer them honestly. If the funder, like if I come to you and I tell you, well, my credit score is not that great, these things happened and this is what I'm doing to bring it up, then the funder is going to look at that information that I've given and now has some more information that allows the funder to make a better decision on whether the funder thinks that I am a good risk. Some of that is not just your credit score. Some of that is your character. How do you pay your bills on time? Okay, do you owe everybody in town? Do you have enough money projected in your new business that will allow you to pay the current debts you have to run your business and this additional debt that you will have to pay off this loan? So that is truly a conversation. And I would highly recommend that if you are looking to go to a funder, to talk to them about getting their money, have this conversation with your trusted advisor first. Have this conversation with your SBDC advisor or your score mentor. Have this information, have this conversation with someone that, have this conversation with someone who can actually, you get the comfort. You need to have a comfort level when you're talking to a banker. And you're not going to have it if this is the first banker that you've talked to, it's the first time you've asked for money, and you're kind of tripping over your words and you don't exactly know whether you should answer this way or that way. So do role play. Sit down with your trusted advisor, go through this process together so that you will feel more comfortable when you actually get in front of someone and you're saying, I would like to have your money. You can say that with confidence and you know how to answer the questions. If you run into a question that you don't know the answer to, ask, what do they need? What specifically do they need? Or maybe why do they need that? Also understand if you're going to a bank, when you talk to a commercial loan officer at a bank, that is not the person who says yes or no to whether you get the money. That's the person who takes the information, does the assessment of whether they can risk sharing their money with you. And then it goes to the underwriting group to decide, is this a good risk or not? If they say yes, then yes, you get the money. If they say no, you always want to know why. Because you want to know what is it that you need to do to make yourself what we call credit worthy. What is the work that you need to do so that when, yes, you are going to ask for this money again because you need it, but maybe you need to do some cleanup in your business, some cleanup with your finances so that when you talk to maybe the same lender or a different lender, that you are now in a different position. So all of that is necessary. And some people are very touchy about their finances. They don't want you to know how much money they make. They don't want you to know how many bills they have. But if you're asking for somebody else's money, please understand they most definitely want to know. They want to make sure that when they give you this money, you are going to give it back plus interest. And it's not going to bootstrap you as a business. It's not going to cause your business to not grow because the whole purpose of getting the money is to grow the business. So when we look at this and we say, okay, now that we have this balance sheet and it tells me stuff. It tells me how much cash I have. Cash from an accounting standpoint, cash is your money in the bank. Okay. Accounts receivable. What is accounts receivable? Accounts receivable is I have a product or service that I'm putting out in front of my customers, and I do so much work and I send the customer an invoice. When I send that invoice, I've supplied what the customer needs, but I have not been paid yet. And so that invoice that I send out to the customer is money that I am expecting to receive from that customer. That's why it's called accounts receivable. This is money I'm expecting to receive. My invoice says how much I want to be paid, and it says when I want to be paid. So it's going to tell an amount and it's going to tell a time, a date. So my invoice may say $5,000 and it may say due in 30 days. My invoice went out on the first of the month. I expect to be paid by the end of the month. Or it could say it's due in 15 days. It went out on the first of the month. I expect to be paid by the 15th of the month. Or it could say due upon receipt, which means the minute that my customer gets the invoice, I'm expecting a payment. So accounts receivable from an accounting standpoint, even though you do not have the money in your bank account yet, is considered an asset because that's money that will be coming in because we're making an assumption, just like the bank has made an assumption with us, we're making an assumption that this customer is a good risk and this customer will pay us for the services that we have. Okay. So assets are broken into two areas. One is current assets and the other one is fixed assets. So current assets are things that can be converted into cash within a 12-month period. Fixed assets are those things that it takes longer to convert that into cash. Okay. And some of that stuff we probably won't ever convert into cash. We'll just use it. But it's still an asset because if we decided we wanted to sell it, it has a price, it has a market value to it. All right. So when we look at cash flow and we look at how money comes into us, and we're thinking, okay, well, cash comes into us from the products or services that we sell. It may come into us as a gift. It may come into us as the money from the loan. It may come into us as money that we put into the business. So we're always going to be looking at how money comes in, and then we're going to look at how do we use the money that goes out. So we look at three different things. We look at the cash conversion cycle, we look at cash flow, and we look at the actual paperwork, the cash flow statement that says this is how money is actually being used. So when you look at the cash conversion cycle, you're saying, okay, I have, in this case, I have a product. And so I pay for my product, whatever it is. So I have to pay for the raw materials or the inputs or whatever it is that I'm paying for. So let's say that the raw materials, if we're talking about the wired cup, the raw materials are coffee and it's pastries and it's things that we put them in, like cups and plates and napkins, et cetera, et cetera, et cetera. So that I have to pay for all of that. Okay. And so that means that my money is going out so that I can buy that stuff, so that I can sell that stuff. So I'm buying coffee and pastries and plates and napkins and et cetera, et cetera. I have to pay for all of that. And then in my cafe, I sell the coffee, I sell the pastries, and we put the coffee in cups, we put the pastries on plates, we have napkins where people can sit down and enjoy what they're eating. So that's what I sell. And when I sell that, I get money. So I paid for this. I now have something to sell to a customer, and now the customer is going to pay me with money so that I can start the cycle all over again. So I can go out and buy the stuff that I need so that I can have something that I can sell to customers so they can pay me. So that's the cash cycle. Now there's more included in what you pay for because you're paying for the employee's wages, you're paying for the rent, et cetera, et cetera. But what I want you to understand is I have stuff to sell. I sell it to people. People pay me money. I take that money. I buy more stuff to sell to customers who pay me for what they purchase so I can go out and buy more stuff. So that's a cash cycle. That's a cycle that you have in your business. My business is training. So I don't have raw materials. I have training materials that I have. So I pay for those training materials. I get them ready. They go to the customer. So the customer pays for my classes and pays for the materials that I bring to the classes. And with that money, I pay my business expenses, just like what you will be doing. So then when you look at the cash flow diagram, this looks so convoluted. And it's not as bad as it looks. What it says is, how do I get money in? I get money through customers. I get money from people that I borrow from lenders. I get money from people who want to invest into the business. So what the money that I get from the customers becomes an asset. The money that I get from lenders becomes a debt. And the money that I get from investors becomes equity. That tells me that the worth of my business is improving. So I'm always looking at that accounts receivable because I said, wait a minute, I am making a huge business assumption based on the fact that I think this customer has a low risk ratio. I think this customer will pay me when I send the invoice. So, quick note, business owners, please remember to send your invoices. I have had customers, I've had clients that when I look at their books, I go, this customer hasn't paid you. Oh, I forgot to send the invoice. Do not forget to send invoices. That is, you're allowing your customer to use you as a bank. You've given them the product or service. They haven't had to pay you. That money is still sitting in their pockets and it's not in your pocket. You want to make sure that you always follow up with the customers. You always want to look at, when you look at all this stuff that's coming in, you want to look at what's going out. So you're looking at, like you have to pay labor, you have to pay for your employees, you have to pay for the materials that you have, you have to pay for the place where your business is located. So there are things that you have to pay for, and you need to have the money to cover that. So the money that comes in from here has to pay for what we do down here. Okay. So I'm not going to go any deeper into that because this is not an accounting course, but I just want you to understand that money that comes in goes out. Your job as the manager and owner of this business is to know what is coming in and why it's coming in. It's coming in because my customer is paying an invoice. It's coming in because an investor put some money into our business, etc. And you need to know why your money is going out. Where is it going and why is it going? It's going to the electric company because I'm paying my electric bill. It's going to XYZ supply company because I'm paying for my materials. So I always need to know what's coming in and why, and I need to know what's going out and why. So when we look at the wired cup and look at their cash flow statement, it tells you how much money that Bob has. Okay, so he's only got so much money that he can play with. And of that money that he has to play with, is it enough? How much money is moving in and out of his business? Is he bringing in enough money to cover what he needs that of the money that's going out? Where is his money coming from and where is it going to? And when that money is moving in and out of the business. So I need to know the amount, but I also need to know timing. Think about your own business. How is your money coming in? When is your money coming in? Do you have the money to cover the expenses for your business? Is your timing between money coming in and money going out making you feel comfortable that you've got things covered? If you don't, that's what all this is about, is looking at this information about money and making better money decisions, not just the amount, but also in the timing. So what can Bob do? So Bob's got some issues, and we read in his case study that one of the issues that Bob has is that he's got great clientele, but they're not there all the time. This is a college town. They're there when college is in sessions. What does he do when college is not in session? Can he get a better deal from his vendors or suppliers? Can he go to his vendors and suppliers and say, you know, this is what I need. I've figured out what I need in order to make this work from a standpoint of what supplies I need, what materials I need. Can we set this up so that I can pay you for these during these months? Because in the summer, I'm going to be a little short. Or can Bob look at this and say, I know I'm going to come up short, but I'm still going to have customers in the summer. Maybe what he needs to do during the time that 10 months of school is in session, maybe he needs to take 1/10 of everything that comes in, stick it into a savings account to be able to pay those bills when they come up in the summer. And he doesn't have that robust community of customers that he had before. Should he use a credit card? Well, if he uses a credit card, remember, credit card is a loan and it still has to be paid off. So again, he's got to figure out how he's going to pay that so that he can still have good standing within his business and have good standing with those that owe him money and those to whom he owes money. Put money into a savings account, okay, so that he can save up that money so that when it's lean during the summer, he doesn't feel so stressed about not having the customers that he's going to have in the fall, but because he knows he's got his buffer money there that will pay for those bills. I think that's a great idea. Anybody else? So what Bob needs to do is really think this through and come up with ways that he can help himself. So you, as a business owner, you need to think of what you sell and what is your cycle. In the retail business, most retailers get 90% of their business in November and December. So we know we like to buy presents, we know we like people, and we like to make sure that they feel good about the gifts that we give them when we go out and spend money. And retailers, if they get 90% of their money in November and December, they better be very good at setting up that money so it can be used during the other 10 months. Okay? So these are some ideas that the class came up with. So increased revenue. He could say his prices have gone up. Okay? Anytime you raise prices, you also need to think about what effect that has on your customers. For most businesses, they think, oh my gosh, the minute I raise prices, I'm going to be in such trouble. Nobody is ever going to buy from me ever again. And usually they're wrong. Increased prices, people still show up. Sometimes people show up and tell you, well, I was wondering when you were finally going to raise your prices because your prices were so low. Maybe your prices were not appropriate, okay? Maybe your prices did not fit into the market, what the market is bearing. Provide incentives for customers. He could start catering. In the summer, maybe there are some businesses out there, not just necessarily in the summer, but all year long, who could use his services for their business meetings. Maybe he could do lunch, or maybe he could do breakfast. Okay. There's a lot. I'm not going to read all this stuff. You can see what this is, but there's a lot of things that can be done. There is a business in town called Rachel's Kitchen, and Rachel's Kitchen just got an award, a Small Business Administration Award on Friday. And one of the things that Rachel's Kitchen does is it has restaurants in various parts of town, but they also have what they call Rachel's Kitchen Express. And that's a restaurant where they don't have the full amount of what they have in their major restaurants. They have a portion of the amount because that location is one that is basically a business area, and breakfast and lunch is probably what people in that area will be doing a lot of. So they reduce their menu. So that's also a thought about looking at what your menu offerings are. So there's a lot of options, and think in terms of your business. There's probably a lot of options for you too, but again, it's about sitting down and thinking about it or having that conversation with your trusted advisor. Now, these are what I'm being nice when I say, please excuse me. I'm being nice when I say this. These are no-nos. Okay? Don't ever mess around with the taxes, whether they are your employer taxes, whether they are your payroll taxes, whether they are your employee taxes. You never mess around with taxes. The way the government looks upon taxes, and it doesn't matter what part of the government you're talking about, they look upon taxes as the minute that you get them, it's their money. So if you're selling something that has a sales tax attached to it, the local sales tax authority has already assumed that that sales tax money belongs to them already. You're just holding on to it until they come to you and say they're ready to get it. So it's not your money, it's their money. This is how they look at it. And if they go to get their money, oh, and you don't have it, you don't want that kind of trouble. It truly is not worth it. When you are talking to people about loans, when you're talking about coming to ask for other people's money, please be honest with them, because that's part of your character, is the honesty, is the integrity that you bring to the table. Please be honest with them. If you can't pay your vendors on time, get on the phone and tell them. It is not the most comfortable conversation you will ever have, but it is definitely a necessary conversation that you have. Don't overestimate how much you think is coming in, and don't underestimate how much you think is going out. Be conservative, and be conservative from the standpoint of, say that your revenue, you think that your revenue is going to be $10,000 a month, but when you look at your track record, it's running about 8. Then don't say that your revenue is going to be 10,000 and then try to estimate your costs based on 10,000, because your track record says 8 is where you are. 8 is where you should hold on to until you actually get to a higher amount. So be very careful in estimating your revenue and expenses, because you don't want to have said you're going to do something and find out you don't have the funds to be able to do it. Ask for help. So you hear this from me all the time. You hear this from all of us. Ask for help. Reach out to the trusted advisors. Reach out to find out who they are and what they do and how they work and what information do they have. Ask for help, okay? And you don't necessarily have to go to an accountant to get help, but it doesn't hurt. If you have somebody who's doing your books, sit down and ask them questions about how they're putting things in your books, how they're putting your transactions in, and talk to them about what you're looking at, how you need to read this. I want to make sure I understand what this report says. I want to make sure that I've got this information so I can make the best decision that I can make. So it's extremely important that you understand your money coming in, your money going out, how you can make decisions about how your money moves. It's not just the money, it's also the timing. It's how you use money in the business. Are you saving some money so that you can buy a piece of equipment? Are you going to get a loan because you need that piece of equipment now? And if you do that, do you have the ability in your business? Do you have that flexibility that allows you then to pay off that loan? If your business is seasonal, look at what your high seasons are, look at what your lower seasons are, and figure out, how do you use the income coming in from the higher seasons to be able to finance you during the lower seasons? Make sure that you are always on top of what's happening in your business with your finances. We know that we live in an era of cybersecurity. We know that we have a lot of threats that come after us. People are always looking to take stuff that we have. It's our job to stay on top of our business. We can't blame the bank. We can't even blame the hacker. It's our job to stay on top. So we need to be making sure that we're looking at our money constantly. And because banks are so electronic these days, you don't have to wait for somebody to send you a piece of paper. You can actually go in and just take a look at your accounts, whether they are bank accounts, whether they're checking accounts, savings accounts, credit card accounts, loan accounts. You're looking at all of that. You can just go in, take a look, and it tells you where you are. If you see something that you think the business should purchase and you don't know how much money you have, you can't make a good decision on whether or not it's worth it to purchase that item. So you want to stay on top of, and I know I sound like I'm beating a dead horse, but I want you to understand this is your money. You are the owner of this money. It is your responsibility to make sure that this money does what it needs to do to help you build a strong business. So in your resource guide, you're going to see some cash flow terms. You're going to see a cash flow statement template. You're always going to be able to ask questions. Just make sure that you are asking questions, and resources are always available. Here in the state of Nevada, we are resource rich. We have so many places and so many organizations and so many people who are willing to help us. So it's okay to ask questions. As a business owner, you are not expected to know everything, but you are expected to know how to reach the proper resources that will help you with your knowledge base. So in your participant manual, there is an evaluation form. I would like for you to fill out that evaluation form. Tell me what you thought of the class. So please send that to me. This is my email address. I think you all have that, but it's right here for you. Please get that information back to me. And let's just talk about some of those resources for a quick moment. And Roadmap is a resource map of you and your business journey. So it doesn't matter where you are in your journey, just click on that particular topic and you will have resources that are available to you. This is brought to you by the Nevada Department of Business and Industry. Also, we have a virtual classroom, and so some of our classes are in English and some of our classes are in Spanish. This one will also be in the virtual classroom, and you could always go there and review or do it on your own time. So you can review what the classes are, pick those that make sense to you and are helpful to you. If there is something in there that you look at and you go, I was looking for X and I don't see it, please let us know, because we're here to help you. If there's something that you're looking for and you can't find it through us, let us know. Let's see how we can get that class done for you or answer that question for you. This is what the website looks like. They're working on revamping the website, but right now this is extension.unr.edu/BUSDEV, which stands for Business Development. So we have upcoming classes, We have the virtual classroom. We have the team. Obviously, we need to update that. We have business resource partners, and we have the podcast. So there's a lot that you can, just by going there and taking a look at that, you'll find a lot of information that's offered through the university. We also have what we call the Nevada Biz Life Podcast. The podcast is for you. It is geared, everybody who comes on the podcast is geared towards small business information. Sometimes it is a small business that comes on the podcast. Sometimes it is someone, a resource partner that comes in to talk about what they have available. Sometimes it is someone from the government who's coming in talking about what's happening in the government that has an effect on the small business community. So please go and find us on Spotify. And you can also find us on YouTube, and you can find us in some other places that I don't know all the areas where our podcast pops up. But please follow us, like us, and subscribe. We need your help to keep doing this and getting out in front of small business owners like you. If you are not a client of the Small Business Development Center, you can go here to nevadasbdc.org, click on Request Advising, and then you will get this page. Then you want to go to New Clients, sign up, answer the questions they have, put in the information, and you will get assigned an advisor. Now, let's know that there are a lot more of you small business owners than there are of advisors at the Small Business Development Center. So you may not get an immediate response. Once you know who your advisor is, you continue to stay in touch with them until you can get an appointment, because they're busy and you're busy too. So make sure that you have that appointment and you can sit down and start using them as a trusted advisor. If you are already a client of Business Development Center and you're not sure who your advisor is, go here to contact us and go to the directory, and on the right hand side it has an 800 number, and it also has an email address, and just say this is who you are. You are a client of the Small Business Development Center and you would like to connect with your advisor, and they will get back to you. And of course we have SCORE, and SCORE is made up of people who have been in business, and many of whom have retired from business and want to give back to the community. They are called SCORE mentors. And make sure that if you're uncomfortable with somebody you're dealing with, ask for another person. Okay? So, but you need to feel like this is someone who has information that's helpful to you. That's what it's all about, because it's to help you grow your business to the size that you want it to be. So I want to thank you for coming. We're finishing a little early today, so maybe I didn't talk as much as I thought. And you have my information. You have my phone number, 702-972-3532, and you can text me on that number also, which is probably the easier way to find me. You have my email address, bgbryant@unr.edu, and you have the information to get into our classes and our programs through our extension.unr.edu/BUSDEV for business development. The actual participant manual that you got is in conjunction with the Urban Chamber, and so you can go directly to the Urban Chamber and get it there also. And it's for all the whole series, all 13 weeks of the whole series. But I still recommend that you always get that participant guide, because it's very important that as you learn things, you can go through and do as much as you can from your standpoint. So thanks, guys. Glad you could be here. Have a great day.